IT index is down about 0.7%, and straight up 2:1 declines to advances. Straight out the gate, 3 stocks are higher, and majority of the stocks are starting in the red. And now it's a 1% cut, by the way. 260 points lower. 22,780 is where we are at. 22,786, of course, is that low that we got to on the 27th of January, and which we kind of sort of tested in a way on Friday as well, and from where we bounced. So it's a firmly lower start to begin this session. Surabhi. Okay, let's quickly look at what's taking it down. 176 points, 186 points low right now. M&M, 3% down. BEL, Tata Steel, Shriram Finance, ONGC, it does not matter. NTPC, Hero Moto. It's across the board. It's absolutely indiscriminate. Apart from Sun Pharma, Cipla, there's hardly a red tick. This looks like a huge sell order has been executed first. I mean, someone was sitting with a huge sell basket, decided to just go slam dunk on the Nifty. It's not about sectors, it's not about stocks. Now we are 200 points down. I'm at loss of words, Nigel.
Well, that's right. In a few stocks, actually, that are taking it very, very hard on the chin, I think. So, Utkarsh SFB, that stock's down close to around 12%. RVNL, that's down close to around 6%. I think it's reacting to its numbers. So, big downtick is what you're seeing out there. Ircon as well is pulling back in today's trading session. So, a couple of these names have come in for selling. REC and PFC, they went one way up. Both of them have come in for some selling. What's done a bit of a U-turn? Manappuram Finance, the stock was down close to around 10% on Friday's trading session. That's pulled back close to around 3% in today's trade, so keep an eye out on that one. GSK Pharma, that's up close to around 6.5%, so good move is what we're seeing out there. Volumes fairly okay actually for a counter of this size, so that one as well is up close to around 6% as we speak. And otherwise, the breadth of the market is dismal at around 250 stocks that are advancing for 1,850 stocks that are declining. A quick word on a couple of stocks that are under pressure. D Development, that's one of those IPOs that listed, I think, in the last 12 months or so. That's down 20%. That's in reaction to its numbers. And these sort of accidents make markets very, very nervous. Best Agro, that's another one that's down close to around 15%. And Zen Technology, as I recall, they raised money at much higher prices. The stock had gone all the way to around 2,200 odd. Now it's close to around 1,100. So that's the kind of selling that you're seeing. Some of this selling has to do more with regard to trading positions, I think so, rather than fundamentals. As we speak, big downtick is what we're seeing out there. Stock down 20% as we speak. All right, well, let's go straight across to Sanjeev Prasad, who's now with us, Managing Director and Co-Head at Kotak Institutional Equities. Sanjeev, good morning. Great to have you back on the program. Thanks very much. And, wishing you all the best of luck for the conference. And I think you'll get, I'm sure, lots and lots of questions. You were, of course, early on and steadfastly cautious through I dare say you were wrong for a while, but I think now, of course, it's out there for everyone to see. So where does, after what we've seen in terms of the correction, the small cap index has lost about a quarter of its value from the highs. The mid cap index has lost about 20% from its highs. Where does it leave us, pure valuation-wise, Sanjeev?
Well, it's the same thing which we have been saying for the last 1 year or so. And if you look at the valuation of the large cap index, let's say the Nifty 50 index, it's not too bad, roughly about 20 times 1 year forward, about 7.5 on a March 27 basis. There will be earning downgrades, I'm sure, in some of the sectors. But broadly speaking, I don't see too much downside, as far as the large caps or some of the large caps are concerned, namely the financial names, IT, pharma, etc. Yeah, there are still pockets of overvaluation even in the large cap, but I can live with that. The problem still remains in the mid cap and small cap, areas that is sector dominated by mid cap, small caps, or the mid cap, small cap stocks. Still a lot of froth over there, and I think you would see a lot more correction over there because the fundamental value of many of these companies are far lower than whatever the current market caps and prices are. I mean, you talked about RVNL. Just now. I mean, the market cap of the company is something like 75,000 crores even now, by the way. Yeah? I think it is still at about 8 times book value, if I remember the book value correctly. Yeah? And about 40 times on March 24 profits. And the railway budget this time around, there's no growth in the railway budget, right? So where is the growth going to come from for some of the railway stocks which had become very, very expensively valued? So there are still pockets of, I would say, froth in the market, and that will get flushed out over the next few weeks. Looks like the way the market is going.
So, Jeev, this I was looking at this data point in the morning. If you look at the small cap index, right, with this correction we've seen, the 10-year CAGR now has fallen to about 11%, which is in line with the long-term average now. The mid-cap CAGR 10-year is now about 14%, is 14%. Again, it doesn't seem, I mean, that excess or excessive kind of fraud seems to be out, but of course these are averages. The other point is markets really settle at averages, right? They overshoot and then they undershoot. But you're saying on an absolute basis as well, and you gave us that example of RVNL, there are large pockets of overvaluation and excesses, right?
Absolutely. Yeah. There are just so many stocks here, especially in the mid-cap and small-cap areas. So either you have companies which are trading at very expensive valuation but have decent fundamental. These are the high-growth companies, let's say in the capital goods space, EMS, etc. But we just struggle with the valuation of these companies, and they are so much priced to perfection, even now, by the way, despite coming down 20-30% from their peak levels. So any disappointment, you would see a big cut in the market price over there. And then you have many other stocks which are not displaying any great numbers, especially on the consumption side, and the valuations are still very, very rich. And in most cases, the multiples are significantly higher than the pre-COVID levels, and the growth is significantly lower than the pre-COVID levels, so which makes no sense really. And in many cases, you are seeing a lot more disruption, medium-term challenges, structural issues cropping up, which were not there 5-7 years back when the market was willing to give much higher multiples to the same sector in stocks. And then you have a bunch of completely rationally valued, sectors and stocks which have no real fundamentals, but the prices have gone up, very high for whatever reasons, and now they are giving way, and these will correct really, really badly, and unfortunately a lot of retail money is over there from whatever I have looked at some of these stocks.
Which are these, Sanjeev? The ones that are looking absolutely still insanely overvalued and where earnings are just not justifying?
Just
or which
at,
pockets? I mean, if not stocks, which pockets?
Some of the PSU. Look at the PSU names in railways, metals. You will get a very good sense.
Okay. By the way,
I mean, not the large cap ones like let's say.
Yes, please continue. Please
NTPC, Power Grid, etc. may be okay, more reasonably valued now. I was just saying NTPC, Power Grid, etc. may be more reasonably valued. But look at something like a BHEL, which we have been sounding cautious for the last 1.5 years now. The stock went up from whatever less than 100 to 300, now down to below 200. I still think it's supremely overvalued. It will come to below 100, or rather, I should say, I can't forecast stock prices. The fair value of the company is below 100 in my view. Right? Still my view, but that's what it is. And I can give you the math on that, but anyway, let's keep it for a
Got
second.
it. You're saying even within PSUs, there are the likes of NTPC and Power Grid where you think now the corrections made the prices a little reasonable, but BHEL you'll hold your verdict on that one. By the way, just want to report that from a very sharp gap down, now there's an equally quick recovery in the market as well. Should take note of that. There's a V-shaped recovery right now on stocks like Bajaj Finance, Tata Motors, Apollo Hospitals, NTPC, the stock that Sanjeev was just talking about. So we had this slam dunk, and now the buyers have quickly crept in, and those charts are suggesting that. Sanjeev, just very quickly, at a headline level, I was looking at, for instance, some of your peers, Motilal's note, they were saying for FY26, the Nifty estimate is around, I think, 1,203. And they feel that expecting a 15% CAGR is very excessive right now. Where are you on the headline earnings trajectory for FY26? Whether it's the Nifty 50 or the BSE 200, some of the wider indices, what is that big number that you are going with?
So for FY2026, we have 14.9 or 15% growth, let's say, rounded out to 15%. That's on the back of 4% growth in FY2025. But anyway, 2025 numbers are distorted by, much weaker numbers for the likes of BPCL, HPCL, which is not part of Nifty, but through ONGC, these numbers come. And also coal had very high numbers in FY2024. We will have a big decline over there compared to FY2024. So if you look at without these three companies, which is probably right to look at it because there's a lot of volatility in the numbers of these three companies, then the FY2025 net profit growth will be 10%. And for FY2026, now, as of now, we have 14% growth. And I think the EPS number is about 1180 or so for FY 2026.
You're
so
saying
again, the Nifty is not a problem. If you look at the banks are reasonably...
Sorry, Sanjeev, you're saying the Nifty...
14% growth if you take...
Yeah. And X of which companies did you say that the growth number comes down to 10%?
BPCL, HPCL and Coal India. HPCL is not in the Nifty, but its numbers get consolidated with that of ONGC, and ONGC is in the Nifty 50. And there's a lot of volatility in the numbers of these companies. You know, by FY 2024, if you recollect, you had very, very high profits for BPCL and HPCL. And also Coal had this one-time benefit from the change in their accounting policy for the overburden removal, which boosted 2024 numbers significantly. Which is why if you look at the FY 2025 headline number, it is only showing a 4% growth. So that's why we now remove BPHP and Coal from the calculation completely. And if you do that, then the FY 2025 Nifty net profit index, Nifty 50 index net profit growth comes to 10%. And on a like-for-like basis for FY 2026, it comes to 14%. So there will be some downgrades, but I think 12-13% it seems achievable for the Nifty 50 as a whole. See, Nifty 50 again is not a problem. You know, you have companies, you know, like the banks, etc., which are not seeing really any challenges as of now, or especially the banks which are Nifty 50. You know, there are smaller banks who are seeing a lot of issues in the MFI, loan book, and so on and so forth. But there are no real asset quality issues as far as the larger banks are concerned. If you look at IT, pharma, which are another very large portion of the index, you know, they are getting some tailwinds from the big INR depreciation that you have seen, and some recovery, and anyway pharma companies are doing quite okay. So that's not the problem. The real problem, as I keep saying, is, you know, beyond the large caps.
Okay, all right. Hi, Sanjeev. Good morning, and always good to hear your thoughts. And congratulations, actually, on being a little bit cautious, particularly calling out some of these PSU names. You were in minority actually at that point of time, but a lot of this has played out. But let's talk about a couple of spaces that I think you are fairly okay on in. Quick commerce, Zomato, everyone was very, very excited about it. It could be one of the stocks that come into the Nifty as well. That stock has pulled back a goodish bit. Even Swiggy, you know, after it listed, the stock went up 50%. And now it's below the IPO price. What's your view on this quick commerce theme? It's making consumers' life a lot easier, but from a shareholder perspective, what's your view?
No, we continue to like the space. See, these are long-term growth stories. You know, if you look at, let's say, food delivery business, you know, it's now a nice market, only two companies now, basically, Zomato and Swiggy. And if you look at the growth drivers over there, unlike, you know, let's say the FMCG companies who are seeing a lot more competition coming in, fragmentation of market share, etc., here you don't see any of those challenges. So you are seeing, you know, a triple combination, I would say, of more number of users, you know, more frequency of usage, and higher AUV, that is average order value. And each of these levers, if you take 3-4% growth, which should be quite achievable in India, in a country like India, given its growth prospects, the combined growth actually, you know, becomes very, very decent. We are talking about 15% plus in that case. If you have three levers, each growing at 4% plus, you know, that's the kind of growth we are looking at. The challenge remains on the quick commerce side, because obviously, you know, this market structure is still not evolved. You're seeing a lot of competition, a lot of cash burn over here. I think it's a matter of 1 or 2 years before things start settling down. Obviously, things could get a bit more nastier over here. So that's why I keep saying, you know, you have to look at these companies from a more long-term basis. The growth is there. The structural story is very, very powerful, both in the food delivery and the quick commerce part. But yeah, things could, you know, given the challenge around the quick commerce business, the path to profitability has got, you know, extended now. Compared to earlier, we were looking at, let's say, break even in 12 months' time. It will probably be more like 24 months' time for all you know. I mean, I don't know. It's still evolving, the whole space. And we don't know what the likes of the e-commerce players will eventually do over there, or the modern retailing guys, what they will do over here. So you could eventually have a 6 or 7 player, you know, a market, you know, all fighting, you know, for the consumer wallet. And, you know, things could remain, you know, in a state of flux for some more time. So yeah, so that's what is reflecting in the stock price currently, not the concerns around long-term, any challenges, you know.
All right, no, absolutely. Sanjeev, the other question, and you'll have so many foreign investors also at the conference, right? Foreigners have sold some $21 billion of Indian stock from the peak in late September last year. So this year, I guess, you know, we're giving back some of the crazy run over the last few years. But global equities generally seem to be, I mean, we're looking at Europe, for example. The Euro Stoxx 50 has come back to its same level as year 2000 after 25 years. Things are rising from the dead. China, for example, has started on a good note. Mostly tech, though. Does this mean more competition for this foreign capital? Because there was this argument which was made last couple of years that, there's only US and India, and that played out, for a while. Where do you stand on foreign flows, Sanjeev, from here on?
The foreign flows, I suspect, we should assume for the time being it's not coming back in a big hurry. And the reason for that is pretty simple. There is no new money coming into emerging market funds for the time being. And I don't see why that situation should change in the next 2-3 months at least, given the fact that the US market is doing very well. You have a lot of, policies which are still evolving, as far as the new US administration is concerned, which could work against the EMs for, if you see more, tariff being put on exports from some of the emerging market countries. So as of now, I would say most asset allocators would be a lot cautious on emerging market. And that's been the theme for the last, 3-4 months now. This whole thing started from late September when, first of all, I'm talking more from India perspective, first you had the India to China pivot, when China announced a host of policy measures, fiscal and monetary, to reboot the economy. And very quickly, by end October, when the chances of Republican Party winning all the 3 arms of the US government, started to build up, the so-called Trump trade, you had a pivot from EMs to the US. And that trend, unfortunately, has continued, from a perspective of EMs. And you see the fundamental problem still remains the same, right? If you look at the performance of emerging markets, it's been a disaster for the last 10 years. The MSCI EM index is up 13% in the last 10 years, cumulative that is, which means 1% CAGR. Against that, the S&P is up 200%, so that means 3x. NASDAQ is up about 300%, that means about 4x, by the way. So that's the comparison an asset allocator, which could be an endowment fund or a pension fund in the US is looking at. And everybody looks at trailing returns, and decides, okay, fine, US is the market to be in. Plus, you don't have worries about, currency and so on and so forth. So why bother? And I suspect that may continue till the time either something goes wrong in the US, but obviously then it means pain for the rest of the world also. Or, somewhere EM valuation come to a level where, people, start looking at a lot more favorably, which is what seems to have happened in the case of China at least. Valuations were attractive. Certainly you have this excitement around, DeepSeek and AI-related tech. You have seen all the tech companies, bouncing back, and also China has decent, tech companies. So that is excitement now, but remember, it is basically the same money which is rotating between various EM markets. And unfortunately, India will not get any money in the process, because if China's market is doing well, India will probably struggle, which is the second leg of the problem. So first you have an EM to US problem. Second is, as of now, looks like again you have India to China pivot, which is going on.
Absolutely, and that's showing up in those numbers, right? 14-15% up in the Hang Seng, multiple wars, and that's a real sobering thought, Sanjeev. Final question, where does it leave us then? Does it leave us, is the best case a time correction? The market does nothing, spends the whole year consolidating. Is that the best case? Or is there still the possibility of seeing more downside, despite the mutual fund support that the market has got the last so many months?
It ultimately depends on how the retail investor, takes this period of pain, which has been there for the last 12 months now, come to think of it. If you look at the Nifty 50 mid-cap index, Nifty 100 mid-cap index, I think it's up only 3% in the last 12 months. Nifty 100 small-cap index is actually negative last 12 months now. So, and the last 3 months have been pretty ugly for both mid-cap and small-cap indices and stocks. See, there are some interesting data points. If you have the time, I will share. See, there are 2 issues over here. When people believe Indian retail investors have done very well, keep in mind the fact that you have a lot of new investors who come to the market in the current financial year. About 8 million out of 53 million unique mutual fund investors have come in the last 9 months here. And these are investors who I don't think will have the risk appetite to bear a big market correction. So how they are behaving, I don't know, but I'm sure there could be some signs. I suspect there could be some signs of panic over there. The second more interesting data is when the money has come into mutual fund, by the way. So if you look at last year, that is calendar 2024, 4 trillion rupees came into mutual funds, equity mutual funds. And that is not very different from the cumulative numbers of 21, 22, 23. 1 trillion in 22, 1.6 trillion in 22, 1.6 trillion in 23. So that's about 4.2 trillion. So the more important point is, if you look at the weighted average price of acquisition of retail investors, it's actually quite high, not as is made by the return. So it's not as if retail investors sitting on a lot of great returns. When they put money also matters. Who has come into the market of late also matters. There is
so more downside. So is there more downside?
I don't know. I don't know, Baba. You see, who knows the mind of retail investors, right? If they are reasonably, confident about the future, they stay invested. But if they start panicking based on whatever we have seen last few weeks, then I don't know what's the bottom of the market in that case.
That number is, Sanjeev,
especially
8
for some
million.
of the low quality, low liquidity.
Yeah, 8 million out of 53
see,
million unique
the data
MF
again.
investors.
20,
yeah.
Yeah. Came in the last 9 months, and they are probably all lost money. Yeah.
Yeah. And the other point.
The market is down since then, no? So clearly they have lost money.
Yeah.
4 trillion rupees has come in calendar 2024, which is similar to the entire money which has come in calendar 21, calendar 22, calendar 23. So the point is the weighted average cost of acquisition of stocks through the mutual funds is actually high. It will not be very low. Huh? So the index looks very good on a 3-year basis. I don't think individual portfolio returns will look that good on a 3-year basis, because when you put money also matters, right?
Absolutely.
If you have put money in 21, you would have been sitting a lot of gains. If you put money in 24, you have lost money actually. And if you put more money in 24 versus in 21, then your average return will still be not that great, right?
Yeah, absolutely.
The question is, if you put in 2025, is it a right?
The retail investor has to deal with. Yeah.
The question is, Sanjeev, is in 2025 you're getting a bit of a dip. How much more pain will you make money from here on? That's going to be important as well. The entry is extremely important. And sometimes, periods like these, it's anyone's guess which one it'll go.
It's a long way to go. For the mid cap and small caps, be very, very careful. Yeah.
Got it, Sanjeev. Appreciate.
Ultimately, you have to be very focused on value. Yeah. Okay. Thank you.
Absolutely, Sanjeev. So maybe the large caps could be protected to some extent, but mid and small caps, that could be a lot more pain in store. Thanks a lot for joining in, Sanjeev, and giving us some of those sobering thoughts as well on the markets. By the way, when we were having that chat with Sanjeev, the advance decline ratio moved all over the place. At one point of time, we were less than 250 stocks that are advancing. That number went to around 1,000 stocks, which is back down to around 550 stocks that are advancing as we speak. But just looking at the screen, it appears, select stocks, they got hit just purely because of selling at the open itself. Bajaj Finance, pull up the intraday chart, stock was down 4%, now it's moved into the green. Tata Motors as well has seen a big pullback in trade. That as well was lower. Coal India as well. Mahindra and Mahindra, we're talking about those good numbers that they deliver. Take a look at the stock. It's down 4.5%. That's the kind of market we are in. The news is positive, but that stock has come in for some selling. Well, let's talk about BEML. That's the one that's on our radar. The last couple of quarters, the numbers have been a little bit disappointing. They were earlier guiding for close to around 20% revenue growth. But as things stand, as of 9 months, it's actually a bit of a degrowth. So understand how's business shaping up. We're joined by Mr. Shantanu Roy, the Chairman and Managing Director of the company. Hi, Mr. Roy. Good morning and thanks a lot for joining in. Well, last few quarters, performance hasn't been great because of the execution problems. But now we're looking at Q4. What kind of a revenue number can you deliver? Your first 9 months, the revenue degrowth is close to around 7%. To even match FY24 numbers, you'll have to do revenues of close to around 1,700 crores. So what do you end this year with? Are we likely to see a flat number in FY25 in comparison to FY24, or are we bracing for a degrowth? Please go ahead, sir.
Good morning, Nigel.
Morning.
It's very good to be back with CNBC-TV18. Yes, the numbers have not been very good the first 9 months. But let us understand, we have 3 business verticals. And out of the 3 business verticals, the mining and defense have done very well. The rail and metro has been down by almost 50% as compared to last year. And in spite of that, the company has held its ground. And that talks about the resilience and the versatility of the company. We still have 45 days to go in the current year, and we are working towards the aspiration that we have. And if you look at the most positive aspect, that is the order book. If you look at the companies, if you look at the order book history over the past 5 years or so, never before have we crossed 5,000 crores except 1 year. And last year it was 7,000 crore of order inflow. This year we are already at around 6,000 crore. And the coming 45 days, it will be another 3,000 crores. The highest ever order book growth, highest ever order inflow for the company in a financial year. That is what we are going to achieve this year, which talks about the long-term value that the company is going to create. So yes, quarter-to-quarter financial results are very important. It's very important for the investors. But at the same time, the kind of value that BEML is creating, that is phenomenal. The value in terms of the deliverables, the bullet train, the high-speed train, the Vande Bharat sleeper, the engine for the defense forces, the indigenized high-end mining equipment. So that is long-term value. And it's a test match, basically. So test match, it takes time.
Okay, all right. But, on a day-to-day basis, we need to see how the test match is playing out, right? So let's focus on the initial session itself. That is the upcoming session, FY25, what you'll end with. You have done roughly around 2,300 crores. Earlier, going by the projections, from 4,000 crores, you should have ended the year at around 4,700 to 4,800 crores. So realistically, for this year, what will you end the year with in terms of revenues? Point number one. And you had indicated that margins will improve by around 100 basis points. It's in that vicinity of around 7.5 to around 8%, 7 to 8%. So are we on track to see margins further improve from here? Revenues for this year, for next year, as well as margins. Please go ahead, Mr. Roy.
You see, Nigel, as I said, we are in the final few days, I would say. And since the third quarter, the growth has been quite phenomenal in the month of January, as well as what we have seen in the first 17 days of the current month. And with Rail and Metro, it is on the verge of firing. So I don't see any reason why the company should not do well. As I said, we still have around 45 days to go for the current financial year to end.
Mr. Roy, so you'll end this year flat? This year flat revenues, FY25 versus FY24, which would mean you'll have to do 1,700 crores in quarter 4. That's possible?
I did not say that we will end flat.
No, I'm asking you.
I believe that the match is not lost till the last ball is bowled. Okay. We have the orders with us. We only have to focus on execution, and that is what we are doing. Our current order book, as it stands, at around 15,000 crores, out of which 60% comes from Rail and Metro, 30% comes from defense, and 10% comes from mining. And the coming 45 days, the order that we are expecting, whatever mining orders we get, that we are going to execute in the current financial year itself.
Okay. So we shouldn't rule out a 10% growth at least for this year, given that you'll be batting right till the last ball. Some growth in FY25 versus FY24?
Nigel, you are trying to put words in my mouth, but let's wait for the results. Definitely there will be growth. And,
okay, there will be growth.
Definitely there will be growth. And as far as the EBITDA is concerned, 100 basis point EBITDA that I had given a guidance, we are working towards that. And let's see how the next 45 days turn out for us.
Okay, all right. So at least there'll be growth in FY25 versus FY24, but you're taking it down to the wire. So we'll have to see how much of growth can you deliver. So we'll wait by for that. Also, just to confirm, the order book is around 15,000 crores, and you're talking about incremental orders of, I think, 3 to 5,000 crores. There'll be some execution as well. So you'll end the year with an order book of close to around 18,000 crores?
Yes.
Okay, got it. Also, just a word on your working capital days. That got a little bit, went up a little bit, I think, to around 260 days odd. I think normally it was in the previous year, in the same quarter, was around 230 days. Apologies for that. Do you think things will improve from here on? What is the working capital days we should be working with?
You see, the working capital has always been a concern. And one of the biggest reasons of the working capital going up was the inventory that we had built up, and which we will execute in the last quarter. Once we are able to do that, we are also working on reducing our debtors on a mission mode. Once that is done, I am sure the working capital when we end the financial year will be better as compared to last year. And also, when the company is in a state of transformation, we are undertaking so many development projects, we are undertaking so much capital investment. So sometimes, definitely, yes, it happens that the working capital it gets stressed. More so when we have not gone for a long-term debt in spite of going for a huge capex. So, but that we are going to change next year. We are now planning to go for some long-term debt to fund our capex infusion. So that will ease out the working capital in the next financial year to a great extent.
All right. We'll leave it there. We had more questions, but short on time. But good luck as you execute. Continue to execute, and hopefully, we'll see some sort of turn as far as the stock is concerned as well, because the business seems to be in decent shape. 28.31 on BEML, off the highs of about 5,500. We'll take a quick commercial break here. Up next, we connect with the management of Samvardhana Motherson International. We discuss their performance for the quarter gone by. Stay tuned.
Welcome back. Well, the top loser on the Nifty actually is Mahindra & Mahindra, and they had declared their first day, first show EV bookings, which actually look quite good. But it appears the street wanted more. Sudarshan joins us to break that down for us. Sudarshan.
The stock is top Nifty loser, down around 5%. It's despite strong booking. This company has disclosed for its recently launched two electric vehicles, that XEV9E and BE6. Company has received bookings of around 30,200 units with total booking value of around rupees 8,500 crore. If one reason I can attribute to it might be profit booking, because company stock has outperformed its peers. If you look at the performance of all the auto companies in last few months, even most of the brokerages remain positive on the stock. Citi has a buy call with a target of rupees around 3,700 per share. It says absolute volumes of BEVs much lower than some of recent models launched. It says, but needs to see how the EV facility ramps up and what is cancellation rate. Nomura too has a buy call, target is around rupees 3,700 per share. It says impressive start for BEVs with 30,000 bookings. Co has received 56% and 44% bookings for 9E and BE6, and 30,000 order book is a very strong number that company has received. GS2 has a buy call and target is rupees 3,800 per share. It says 30,000 bookings to imply 8% incremental SUV volumes for FY26, and BE6 and XEV9E models to collectively contribute 8% and 18% to FY26 SUV volumes. Elara 2 has a positive note on this. It says 30,179 bookings seem to be very good. So overall, all the brokerages remain positive on the stock after the company has received bookings for its EVs, but stock is under pressure, down around 5%.
All right. A little recovery from the lows, but 3.63, about 4% lower still. So thank you very much for that. Let's stay with auto. Samvardhana Motherson is the next company on the radar. Third quarter numbers largely came in line with expectations. Margins were higher than estimates. They've also witnessed a sharp reduction in gross debt. We are joined by Pankaj Mittal, Chief Operating Officer, and Kunal Malani, Chief Financial Officer at the company, who are with us to take some questions. Gentlemen, good morning. Good to have both of you here. Prashant, this side. Pankaj, so third quarter largely in line, but concerns remain around demand, especially in the European market. And over the last few months, we've seen majority of the European OEMs reporting decline in production. Could you give us a sense there? I think we've started last few conversations around this, but this still remains top of mind. Is the situation at the margin improving at all? And I'm taking my cue for that question from at least stock markets in Europe, which are starting to recover after many, many years. You look at, the FTSE, the DAX, other markets, the Euro Stoxx 50 starting to come up a little bit. But tell us from a real ground-up level, especially in the auto side, what's happening?
A very good morning, and thank you for bringing us on the show. Motherson has a very diversified portfolio. So you see our performance in the light of a transitioning industry, where this diversity has given a very resilient and stable performance. Europe automotive market, or for that matter, any other automotive market, may have some bumps up and down, but automotive demand continues to come back as people really want transportation all across their life, and it'll not come down in a long run. So we remain embedded with our customers. We continue to develop all kinds of vehicles, be it hybrids, ICE, or EVs. And as you see that most of our business portfolio, nearly 95% of it, is powertrain neutral. So in that sense, Samvardhan Motherson is positioned in a very strong way.
Gentlemen, before we talk about the Q3 numbers and the projections from here on, I just want to get this whole international uncertainty around tariffs, this whole conversation out of the way, because you have lots and lots of assets overseas, and obviously you're pretty big in exports. So first up, what is your total exposure to the US market? What is the quantum that you're exporting to it? Because I think you have various entities, I think some of them perhaps even in Mexico, some of the recent acquisitions. So just tell us, what is your net exposure and what are you preparing for in case those tariffs in the US, if they go up? Kunal, you want to take that?
Sure. Good morning, everyone. Look, we are around about 18% odd in the US in terms of our presence there. Mexico is around about 4% odd. Reality is we have a global local policy or a global local strategy. We manufacture where we are selling, so it is not that we are really importing, exporting too much of our parts. Having said so, there are obviously commodities which move in and out, and commodities in general is passed through in most parts of the world.
Kunal, sorry, Kunal, if I could interrupt just to understand, when you say 18%, are you saying 18% of your revenue comes from the US?
That's
and Mexico
right.
And Mexico is 4%. So 4% of your revenue is Mexico.
That's right.
Sales to Mexico.
That is sales largely to Mexico. There will be some flows that will happen from Mexico to the US. But all of these are structured with a pass-through element in place, right? Or a large chunk of it is structured as a pass-through element, because any customer-nominated parts as well as commodities will have a pass-through element largely for us. So any tariffs movement there really does not have an implication for us. Now, there are some parts which will be being bought by us and imported and exported, while the numbers will be small, and hence any impact there is going to be muted. Plus, the final impact is frankly going to be at the customer end and at the end consumer end, because it's not a challenge for us. It's a challenge for the industry as a whole. And hence, if there is anyone who will have to bear the brunt of it, it will finally end up being at the consumer end / the customer end, depending on what price point it does.
But it's about competition, Kunal, right? Sorry, I mean, just because of lack of time, I'm interrupting, but it's all about competitiveness. Now, if your products will be priced higher if tariffs go up, then what about potential loss of market share and competitiveness?
That's where I was coming to. So in the short term, the reality is it is not possible to change your supply chain overnight, right? At least for the product chains that we make, right? So for us, the implication will be a pass-through. And in the medium term, actually, it's probably going to be a slightly positive phenomena for us, because we produce, as I said, locally. And having a presence in 45 countries, we can decide to rejig our production planning in such a way that we can produce in, let's say, more favorable nations going ahead. versus someone else who possibly does not have the kind of spread that we do. So in overall, it's neutral to positive the way we would see it on the tariff front.
Okay, so now with that out of the way, let's come back to the numbers and the expectations from here on. So given the talk of some recovery in the European markets, Mr. Mittal, if we could come back to you, how does FY26 look at an aggregate when you combine all the businesses put together? What's the sense that you have in terms of top line growth?
See, for us, we see opportunity in all kinds of situations like you mentioned. So we are an acquisitive company, and due to a lot of uncertainty in the market and markets going down or going up, there are lots of opportunities for us on the acquisition front, which our customers are talking to. So apart from organic growth, we are also looking at good acquisitive growth in times to come. And that's why you would have seen that we have also deleveraged ourselves. We are in a very strong position. Our balance sheet is strongest maybe in the last 10 years. So we position ourselves as a very good candidate, working together with our customers, being a very stable and a reliable partner with the entire industry. And on the other hand, we are also diversifying ourselves. As you would have seen that we have also started operations on the consumer electronics business. Our first facility is already ramping up. There are 2 other plants which are on track for SOP in the coming years. So we do see as a company, we continue on our path of creating a more diversified and a strong partner to the OEMs.
Can you, help us map that in terms of some sense of, revenue CAGR when you usually do these 5-year plans, right? And I think is it already time for the next 5-year target or not? Because the revenue at 36 billion target with 40% ROCE, I think that was the earlier target, is it? So what's the new roadmap, CAGR growth and margins next couple of years?
So still, we have to achieve 36 billion. So it's still some way to go, few more weeks. And then we will be coming with an announcement about our next 5-year target. So it is not, as you rightly mentioned, it's not just top line, but let's wait for a while before we come with the next target. So teams are very excited. They're all working. These are all bottoms up. Everybody in the world works together to set their next goal.
Okay, fair enough. Very quickly, on the 2 new acquisitions that you'd announced in the 3rd quarter, Kunal, if I could come back to you. At Sumetic and Baldi Auto, one is a Japanese entity, the other I think is a Brazilian entity. When do revenues from these 2 start kicking in?
We are aiming to close both of them by end of this financial year. So while I think revenues won't be visible in Q4 as much, though the balance sheet may get assimilated, they should be visible in Q1. That's at least the current plan, subject to regulatory approvals.
Okay. And finally, Kunal, just leave us with an outlook on debt reduction. I mean, it's come down again in the 3rd quarter as well. What is the, how will you end the year in terms of total capex? Because I think there's a slight revision, downward revision in the capex outlay as well for FY25 and debt. Where do you see the end of the fiscal year on both these counts?
Yeah, we've reduced the capex guidance to 4,500 crores from 5,000 plus minus 5. Primarily in order to realign our capex planning along with the SOPs that are being planned by the customers. So to the extent we can recalibrate, that's what we have done. Most of this reduction or delays, if I were to put it, is going to happen in the developed world. The emerging markets and the greenfields are largely in line with what the earlier expectations were. So there is no rollback on any of our growth capex going ahead. From a guidance on leverage, we are at 0.9x. We are aiming to close the year somewhere between, let's say, 0.7 to 0.8, subject to any new M&As. We do anticipate a fair amount of working capital reduction to happen, as we've always been saying. I think now we are seeing some of the geopolitical tensions getting potentially eased out. Freight rates coming down, supply chain being a little bit more predictable, and hence the ability to then rejig our working capital, which we hope to achieve part of it in this quarter, part may move into the ensuing quarters. So overall, we should still be on a deleveraging path somewhere around 0.7 to 0.8 or better.
Okay. All right, gentlemen, thank you very much for joining in, giving us a sense of the business and your overall plans going ahead. That's Motherson Sumi, but back to the markets, it's still painful. I mean, there was that attempted recovery, But it's not entirely played out because the mid-cap index is still down 1%, which means it's falling a little more than the large caps. And there you have the Nifty. So, Prashant, not much. I mean, 0.7%. Still lower. Big stocks like M&M, ICICI Bank, Hero Moto, all of them still down. And mid-caps are falling a little more.
Absolutely. And even if you want to do a poll, right, I mean, I think just to do a sentiment check and for institutional investors, etc., the mood is bearish. It's not just negative because prices have been down so far. I mean, if you ask leading questions about what next, where from here, at least over the next near term, in the next few weeks, I mean, generally the feedback is negative in that sense. So that's the picture. 22,760 is where the Nifty now finds itself at. Mitesh is back with us with just a quick view. 22,760. So basically around slightly under those lows last week and the January lows as well. Mitesh, what would you do?
So on the index, Prashant, no sign of a reversal is yet, but we are in that support zone, give and take 20-30 points. So not doing much, but hoping that if there's some sign of reversal, you might want to explore a long position. So for the timing, index is avoided. On the stock side, I have one buy and one sell. Paytm is showing some signs of a reversal, so buy here with a stop at about 730 for targets of 765. And Info Edge and Naukri, I think, that's the stock which is slightly on the negative side. It's had a gap down today. So sell with a stop about 7,410 and look for targets of 7,100.
Okay, all right. Thanks very much, Mitesh, for that. Well, let's just take a quick commercial break here. We're going to come back and we'll just put commodities under the spotlight as well. Focus on what's happening there, what's top of mind. Manisha will help us with that in just a bit.
Welcome back. Let's move over and focus on the commodity markets now. We have Manisha back in the studios after a busy India energy week. She's back here with us. Manisha, so what are the headlines in your markets today?
Well, there's a bit of a profit taking across the market, but I do want to put focus on the precious metal prices right now because we've seen a very strong buying into this one, even as the prices are at all-time highs, the global markets are buying, and gold in some countries is actually trading in premium there. So we have seen an all-time high of $29.40 an ounce for gold prices. We're just about trading above 2,900 at this point in time. There is some profit taking from the highs that we have seen in this space, but let me tell you that the gold prices for last 7 weeks have seen constant gains. So they have given strong returns coming in there. Gold prices in 2024 gained up by 28%. And in this year until now, we are 11% on the higher side. So strong gains therein continuing into the markets and just a couple of months down this year right now. Well, the markets are concerned about various tariffs, and we've seen 3 rounds of that already happen. And then that would mean underlying inflation and a bit of a weakness in US dollar have been some supportive factors in case of gold prices. Apart from that, there has been a very strong shift from futures to paper gold. We've seen that happen in Singapore, much part of China, even US for that matter. And then apart from that, the US Fed monetary policy is something that the street will watch out for. It also is going to be about the US retail sales, where we've seen the numbers decline the most in the last 2 years. That has led to some safe haven buying coming in for gold as well. While there are prospects of peace deal between Russia and Ukraine, that's something that the street will watch out for. But apart from that, there also are conversations about further restrictions coming in from Iran. So the geopolitical concerns also are there in the market. A very interesting report from Capital Economics, and they, while in the near term, believe that $3,000 an ounce in gold is a possibility. But by the time this year ends, the expectation also is that you could be looking at $2,750. And that actually is the view coming in from various banks and brokerages there. I also want to quickly show you silver prices because we're trading at multi-month highs onto this one as well. Highest since October 2024. The prices did gain 21% in 2024. And we have seen prices gain up by 14% in 2025 till time. So good going when it comes to silver as a precious metal also. I also want to show you on what we've done in sense of ranges in case of silver here. So 23 was between 19 to 27, and we've seen a higher highs come in for 2024, 22 to 35. So $7 of a range is what we basically carried on. And this year as well, until now, we've traded a range of $3 when it comes to silver prices. Well, for the week, though, it's going to be the US monetary policy meeting minutes that the street will take cues from.
All right. Thank you very much, Manisha, for that. So that's commodities. Well, in our special segment, Market Masters, Lata speaks with Victor Schwetz of Macquarie Capital on how long funds will pull out of EMs like India and continue to move assets into the US. It's an interesting conversation coming right up.
Welcome to this Market Masters special. Investors and traders are on their edge with tariffs from the US and the threats of tariffs. In addition, the US has reported high inflation and strong labor data. Does all this mean the US exceptionalism will continue? Will foreign funds continue to pull out of EMs like India? And when may the trend reverse now that the rupee and stock indexes have fallen quite a lot? For all these questions, I'm joined by Victor Schwetz, the global equity strategist at Macquarie, and by far one of the best veterans of emerging markets and indeed global markets. Mr. Schwetz, thank you very much indeed for your time. I have a lot of tariff questions, but let me first start with this fund flow question. Since October, India has only seen funds moving out of India and other EMs into the US. How long will the US exceptionalism continue, you think?
Yes, I think if you think of large economies globally, very few can add labor capital and grow multi-factor productivity at the same time. United States is one of them. But another thing to remember, the reason United States is growing so fast, because public sector is aggressively de-saving. So in other words, United States is running primary deficits, not absolute primary deficits, of about 4% of GDP. You can compare it to, say, Germany, which is way under 1%, and the same applies to European Monetary Union. It's double the level of Japan. So it's a mixture of domestic productivity and a very significant de-saving in the public sector in the United States. So what US is doing is basically sucking the growth from all over the world into the United States.
Yeah, reciprocal tariffs are definitely upon us. That's very clear from the executive order. But will that continue to attract more money into the US markets?
Well, there are a couple of questions in there. Number one, why do you need tariffs? Do you try to implement tariffs in order to raise revenue, in order to pay for tax cuts? Are you doing it to level the playing field? Are you doing it to rearrange savings and de-savings? In other words, unless we trade with Martians, unless we trade with extraterrestrials, all savings in the world has to be equal to all investment. So if you try to rearrange it, then by definition, countries like China, Japan, Germany will have to consume a lot more, and the United States will have to save more and consume less. That actually could diminish exceptionalism. In other words, the growth potential, the growth, ongoing growth, not potential, will actually come down. So it's not totally clear what Donald Trump is trying to achieve, whether it's a negotiating tactic in order to get a slightly better deal for U.S. corporates, whether it's beefing up and giving some meat to the base and ensure that the base feels that he is working very hard for American people, or whether it's a genuine desire to rearrange the pool of savings and investment and spending on a global basis. Remember, we can go back to Paul Walker and Bernd Bernanke when they were talking about surplus savings and how we need to rearrange the world. So those are the three very different answers. My view is that there is no particular consistency. He's trying to do all three. He's trying to make sure that the base is behind him. He's trying to bring something to the United States. He's trying to rearrange the world, but there are significant constraints. The biggest constraints he is facing is inflation in the United States, is Federal Reserve, as well as electoral outcomes. Because remember, within 12 months, we will be talking about midterms.
Okay, now to my more important point, what are your views on India? We have already seen steady outflows of funds. Now, at what point do you think India will look attractive to you?
I think my view has always been that investors are too bullish on India. In a sense, expectation of 7 to 8% GDP growth rates cannot be fulfilled by India as it stands today. If you want to get to 8%, either capital efficiency have to be a lot higher than what India is delivering, or you have to improve dramatically domestic productivity, including agriculture, or more importantly, public sector has to de-save a lot more. In other words, public sector deficits has to be running at a much, much higher level. However, having said that, if you think of India, again, it adds labor, it adds capital, it's gross multi-factor productivity, which somewhere around 5.5 to 6.5%, call it roughly 6, should be the optimum level at the current positioning. If you want to lift it another 100 or 200 basis points above that, as I said, you need to address those three buckets. Now, if we think of close to 6% real, that's about 9 to 10% nominal. That's more than double the nominal GDP that China, for example, is capable of delivering. And so at that level, you would say earnings per share in India probably need to be in low double digits. You probably should be looking at 11, 12, 13. The problem is expectations are much higher than that. You're really looking at expectations of 16, 18%. So the way I look at India is a case of growing into growth, which is in essence a much better problem than trying to extricate yourself from the liquidity trap that, for example, China have found itself in. So China, to me, is a safe harbor during a storm, but otherwise it has a very intractable problem. India might suffer during the storm, but essentially India have a circular capacity to continue to grow into the growth that India will be able to deliver.
Actually, Indian companies did have strong earnings growth until last year, running over 15%. Only this year has been slow, FY25. Do you see growth returning, earnings growth returning? Do you see India re-emerging as an attractive investment option sometime in calendar 2025?
No, I still think that earnings per share are too high. As I said, currently expectations are 18, even 19%. They really should be at least 500 basis points lower than what they currently are. And that's why I'm calling growing into growth. Now, when would India perform? Well, there are two things. Number one, certainly in the last 6 months, U.S. sucked in everything. So U.S. growth rates was exceptionally strong. As soon as there is a perception that the United States is becoming more volatile, in a sense that you don't really know what's going to happen, there is some degree of reversion back into other markets. Give an example. If Donald Trump is actually successful in freezing Russia-Ukraine conflict, if commodity prices will go down, especially energy, clearly people will be rotating into European monetary union. That's one of the easiest calls to make. The same applies to emerging markets. As they correct, you actually will have a rotation into emerging markets as well. So to me, it's very hard to predict whether that happens in a week or two or whether it happens in 3 months. To give an example, Europe, just in the last week, already outperformed the United States by 5%. That's a very significant move in what is only a few trading sessions.
Okay, let me come back to tariffs. Where does this tariff war stabilize? And who will be the winners and losers when things stabilize?
Right. Well, if you think of U.S. tariffs prior to Trump 1.0, they were roughly between 1% and 2%. Trump and Biden actually raised it to somewhere around 3 to 4%. My base case scenario remains that probably tariffs are going to roughly double. You could be looking at 8 to 10% average tariffs. Now, that will not pay for the tax cuts, coincidentally, because that will not generate any more than $1 trillion or maybe $1.5 trillion over 10 years, whereas a hole in the bucket is something like $15 trillion. So it will come nowhere near what is needed. But to go beyond that is creating a major problem, because if you only raise the tariffs, let's say to 8 to 10%, the incremental CPI impact in the U.S. will only be maybe 20 bips, maybe 30 bips at most. Because remember, U.S. is not a trade-dependent economy. It's broadly just domestic economy. But if you start going beyond that, if you start going to 15, 20%, this is when you'll be looking at 100 basis points at least high CPI. So the way I look at it, there is constraint on what Donald Trump can do, because the reality is 2 or 3% of the voters who switched to Donald Trump, because that was the magnitude really of the entire switch, did it for what I call 3 I's: inflation, inequalities, immigration. So he can't break those things because then electoral impact will be significant. So to me, there are still the guardrails. Now, there are other guardrails people are looking at, things like congressional and legislative, state and local level, corporate lobbying power, judicial. But the biggest guardrails, I think, are inflation rates as well as the Federal Reserve and what Federal Reserve is going to do going forward. Now, could he decide that the pain is necessary for a bigger picture? Possible, and I think that's what people are nervous about. But I think at the end of the day, he's pragmatic, and I think a more pragmatic answer will prevail. Who's going to be winners and losers? Essentially, if you are an ally of the United States in some form, and that includes Canada and Mexico, that includes Europe, that includes Australia, Japan, India. I think what allies need to do is to give something to Donald Trump, some degree of concession, so Donald Trump can declare a victory. I think positions of countries like China is very, very different. I think this is where it's going to be much stickier. It's going to last a lot longer. But for the allies, I think it's mostly negotiating tactic. And in a number of cases, it's going to get a little bit easier. When you have a conservative government coming in Canada, for example, when you have a right swing a little bit in Germany, for example, India already had India first policy for the last 10 years or longer. So intellectually or otherwise, Narendra Modi and Donald Trump are more or less in line. So whenever you are at that point, I think those countries are going to be fine. And I think the story is different for China, though.
Okay, Mr. Shwetz, what are you expecting from the Federal Reserve this year by way of rate cuts?
Yeah, Fed is in a very difficult position because U.S. economy is so robust. As I said, primary reason it's robust is because public sector de-savings are incredibly high. Instead of thinking of public sector deficits, think of it as contributions that the United States government is making to people of the United States to raise their standard of living and to continue to grow faster. So they're still dealing with a very strong economy. At the same time, they might say, Victor, I agree with you. Donald Trump is not going to go crazy. There won't be any more than 8%. But you're not sure that is not actually not going to happen. So as a policymaker, you have to be somewhat more constrained and concerned. However, if I'm right that there will be no massive deportations, that at best he's probably going to do extra couple of 100,000 deportations. Remember, the biggest deporter in U.S. modern history was Barack Obama. Trump, was only deporting half the number of people that Obama was. Biden is deporting this year, or was deporting last 24, the same level as Obama, one of the highest ever. Could Trump do a couple of 100,000 more? Yeah, probably. Could he restrict somewhat legal immigration? Maybe. But if you keep the net numbers, no more than 20-25% difference, there won't be an impact on 168 million labor market in the United States. So if Federal Reserve feels comfortable that there won't be massive shock on the labor market, if they're comfortable that there won't be massive shock on the tariff side, and if they're comfortable that there won't be massive shock from a fiscal pulse point of view. Because if you, in fact, curtail that fiscal pulse, the economy could crater very quickly. If they're convinced that that is not going to happen, then by the end of the year, they should starting again a cutting cycle. Because nominal GDP of the United States is down already from double digit to 4.9%. On a current path, it should be getting towards 4.5%, which means there is still some room to cut. My view remains neutral rates in the US are about 1% real. If you add inflationary break-even rates, you should be around 3.5%. Now, if you think of the market, 6 months ago, people were looking at 2.7 in January 26. Today, they're looking at 4.2, 4.3. To me, 4.2, 4.3 is too high. 2.7 is too low. You have to have something really horrible happening in the United States to get to that level. So somewhere around 3.5, I still think where Federal Reserve is probably likely to end up.
Okay, so one more cut possible. Would you expect dollar to remain strong for a better part of calendar 2025?
Well, actually, the way I looked at it when we previewed 2025, that US dollar will start higher, much higher, but then actually by the end of the year, it might start easing a lot. And the reason is, if I resolve those uncertainties, if I reserve German election uncertainty, if I resolve the Japanese uncertainty, if I diminish the probability of extreme outcomes in the United States, if I diminish some of the geopolitical outcomes, and we can talk of Abraham's Accord in Middle East, we can talk of Russia-Ukraine freezing, then what you're going to find that US dollar could actually weaken. Now, I know it sounds ridiculous today when US dollar is so strong, but to assume that DXY will go to 115, 120, 125 is really to assume a massively dislocating scenarios on a global basis, which I think, despite all the noise, is probably unlikely.
Thank you, Victor Schwetz. It's always a pleasure listening to you. Thank you very much for joining us. Well, that's it on this edition of Market Masters. Thanks for watching.